Hi, I'm Jim Jackson, and I'm bonding over bonds with my colleague Kevin Kaase. Now, Kevin, this is our last episode of Bonding Over Bonds for 2021. But don't fret, we'll be back with more in 2022. So today we would like to talk about our fixed income outlook for next year. However, I think looking back at 2021 helps set the stage.
I agree. 2021 had mixed results across fixed income. Taxable investment grade had negative total returns as higher treasury yields offset tightening of credit spreads. Both corporate high yield as well as munis both had positive returns.
Sure, and I think, Kevin, as we enter 2022, the top of mind risks are certainly inflation, where we've seen higher prints in recent months, and higher rates, as evidenced by the expectation that the Fed is going to raise rates next year. We think it's instructive to look at what the current spread environment is telling us for prospective excess returns next year, rather than trying to predict where rates are going to go.
No, I agree with that. I have one quick comment on that last statement regarding predictions. In the fourth quarter of 2020, the Philadelphia Fed survey of professional forecasters had the 10-year Treasury at 1.1% for the fourth quarter in 2021. The current rate, last I saw, was 1.38%. So also they forecasted the annual CPI number to be 2.2%, and the last print was a 6.8%.
Well, Kevin, I think those forecasts and how they bear no resemblance to the current environment supports what we like to do, right? So I think it's instructive for us to look at what the current spread environment is telling us about 1 year forward excess return. So when we see spreads around this level, historically, we have seen 1 year forward excess returns as positive for credit. Now, there's a wide range here, but we think that the current economic environment is supportive for credit in 2022.
Agreed. I also think the environment is there's an opportunity for active management. Spread dispersion has been low, which means that the market is not differentiating much by credit risk when pricing bonds.
Well, Kevin, it sounds to me like fundamental credit research can drive alpha in 2022.
That's correct. We're also seeing relative value opportunities amongst asset classes, sectors, rating strata. For example, we really like asset-backed securities, and for those that are tax sensitive, we really like munis. And in this current current spread environment, we think that up in quality trade is appropriate.
Well, it certainly begs the question: what should fixed income investors do? Our answer to that, I think, is consistent through time. It's focus on income. Don't make interest rate bets or macro forecast. Make sure your duration profile is consistent with your interest rate risk tolerance, and stay invested in fixed income. It is a proven portfolio diversifier. So, Kevin, thank you, and thank you for joining us as we bond over bonds.